안녕하세요. 윤재성입니다. 뉴욕생명 자산운용 CIO와 아시아 총괄을 담당하고 있습니다. 이 자리에 참석하신 모든 분들을 매우 환영하고 이렇게 만날 수 있게 되어 영광입니다. 우리 투자팀은 작년부터 이미 인플레이션을 관심사로 눈여겨보고 있었습니다. 시간이 갈수록 인플레이션은 미국을 넘어 글로벌 경제의 위험이 될 것입니다. 인플레이션이 경제에 어떠한 역할을 할지보다도 결국 어떻게 그것을 매니징 하느냐가 더욱 중요할 것입니다. 저희 뉴욕생명 자산운용사의 가장 큰 장점은 멀티부틱입니다. 다시 말해 각 자산별로 전문가 포트폴리오 매니저들로부터 높은 수준의 자산배분 관점과 세계 경제 전반에 더 구체적이고 전문적인 의견을 종합하여 얻을 수 있습니다. 이번 웨비나를 통해 이러한 전문적인 뷰를 바탕하고 글로벌 포트폴리오 안에서 인플레이션에 대한 생각을 함께 제공해 드릴 것입니다. 감사합니다.
On behalf of New York Life Investments and Candriam, it is my pleasure to welcome you to our webinar today, Inflation's Impact on Global Asset Allocation. We will begin with a panel discussion and then open for live questions and answers with our speakers. I would like to introduce today's host and moderator, Lauren Goodwin. Lauren is an economist and director of portfolio strategy at New York Life Investments. Welcome, Lauren.
Thank you so much, and good afternoon, everyone. My name is Lauren Goodwin, and I'm the Director of Portfolio Strategy at New York Life Investments. New York Life Investments is a global investment manager with over $550 billion in assets under management. We're invested in our clients' success with guidance, resources, and investment solutions that reflect the diverse perspectives of our investment boutiques, a few of whom you'll hear from today. We're here today to talk about one of the most cited challenges of 2021, which is inflation. We're sympathetic to the attention to inflation because as the economic recovery gains traction, inflationary pressures are building globally and the markets are responding. On one hand, this is a normal part of a healthy economic cycle. Production declines during a downturn only to face growing resource constraints as demand rebuilds over the course of the expansion, which we are now experiencing. On the other hand, the COVID-19 cycle has been unprecedented in many ways, raising an important question for investors. Could inflationary pressures be here to stay? It's a difficult question to answer as many risks remain. The pace of labor market tightening and the path of monetary and fiscal policy are yet unknown and will determine the pace of inflation in the years ahead. Structural factors impacting inflation are often multi-generational changes and difficult to measure over time. It's a particularly important time to work with seasoned managers who can help navigate these challenges. We have 4 such seasoned managers today to join our conversation and to provide insights on how they see the inflationary environment and its impact to their portfolios. First up, we'll hear inflation views and asset allocation perspectives from Michael DePalma, who is a managing director at Mackay Shields, a leader in income-oriented investing. We'll also hear from Nadège Dufossé, who is the global head of asset allocation at Candriam, a global multi-specialist asset manager and recognized pioneer in sustainable investing. Second, we will dive into specific investor perspectives on real estate and credit, 2 asset classes greatly impacted by inflation. First, we'll hear from Nicolas Forest, the global head of fixed income, also at Candriam. And then we'll hear from Simon Martin, the head of research and investment strategy at Tristan Capital Partners, an independent London headquartered real estate investment management boutique that's regarded as one of the leaders in the European real estate marketplace. One of the benefits of investment analysis at New York Life Investments is the firm's multi-boutique approach, allowing all of us to gain specialist perspectives from across asset classes and indeed across the world today. Thank you all for joining me. Now, just a note for our audience, as we proceed through the conversation, please feel free to submit any questions that you have for our participants in the Q&A box at the bottom of your screen. We'll have plenty of time to answer those at the end. We'll also be asking for your perspective on inflation and monetary policy in the middle of our webinar using the Zoom polling function. So be ready to share your thoughts on whether inflationary pressures will turn out to be transitory. Thank you. Good afternoon.
Afternoon, Lauren.
Michael,
Hello.
I'll start our conversation by acknowledging that we've been speaking about inflation already for more than 6 months now. So can you share with us your thoughts on why investors are so concerned about this factor?
Sure. So there's really two perspectives from which to look at that question. From a macroeconomic perspective, inflation acts as a tax on returns. In other words, whatever you earn on an investment will be worth less after inflation. But inflation also impacts the market's discount rate, potentially leading to changes in borrowing costs and the way assets are valued on a present value basis. Then there's the microeconomic impacts of inflation. At the firm level, inflation can impact a company's levers of value creation. And what I mean by that is their costs of goods and labor, their borrowing costs, and the prices that they charge their customers. Any one of these factors, much less all of them together, can have a pretty meaningful impact on investment decisions.
Say more about those impacts, Michael. It sounds like they aren't always positive for investments and maybe could even be moving in opposite directions.
Right, it's true. So rising inflation can have a dual impact on asset returns. So on the one hand, companies with pricing power can pass through inflation to their customers in the form of higher prices. On the other hand, rising inflation expectations typically leads to higher discount rates, which can lead the market to devalue an asset's future cash flows, and that results in lower present values. Now, these two dynamics work in opposite directions, and the net impact of these two forces determines how an asset will respond in an environment of rising inflation. So as an investor, you care about which of these forces prevails. Factors like how you've positioned the duration of your bond portfolio will play a big role in how the portfolio performs.
Recognizing that it's complicated, where do you stand on the issue then? Are you expecting a persistent higher inflation environment? And how are you helping clients to prepare for that?
All eyes have been on inflation for most of the year already. However, you can tell by the pricing of financial assets that investors in aggregate are not particularly concerned about an inflationary environment. And frankly, neither are we. We expect inflation over the medium term will likely be firmer than in prior expansions, but only moderately so. That said, it remains important. It really does remain an important uncertainty, and risks are skewed towards inflation remaining elevated, at least in the near term. It seems that the market's focus on inflation right now stems not just from elevated readings and uncertainty about when and whether pricing pressures are going to moderate, but also uncertainty over the central bank's new policy strategies and their desire for a sustained inflation overshoot. In addition, supply bottlenecks that we've heard so much about continue to persist as economic activity picks up globally. So how do we prepare our clients for that type of uncertainty? First, we encourage manager flexibility, meaning utilizing as broad an opportunity set as permitted, global multi-sector allocation if possible. This allows people to leverage the interplay between macroeconomic factors like inflation and growth. We also encourage active management. Skilled managers can assess company characteristics that would thrive in an inflation scenario or persist in a disinflationary one. As the macroeconomic environment evolves and as market opportunities change, it is particularly important to consider the specific sources of return that investors can leverage.
That's a good point about central banks and the role that anticipating central banks plays in this conversation. It's also a very good point about manager flexibility, because I think we face a lot of uncertainties here, and being humble is important, anticipatory. Nadège, I'll now turn the conversation to you a bit and just ask, what is your perspective? Are you concerned about inflation?
Yes, that's indeed a very good question, Lauren, and it's a hot topic these days. We had the debate in our investment committee. We currently see prices rise by more than 5% in the US, by more than 3% in Europe. So in a way, we move abruptly from a kind of Goldilocks environment this summer with high growth, low rates to fears of stagflation in September. So it's a hot topic. So we could maybe worried by some short-term disruptions, but we are not worried about longer-term runaway inflation. That said, the post-pandemic environment provides a different context for investors than the financial crisis did. There are many reasons to think that the inflationary environment could change and that we will experience a higher level of structural inflation.
The subtext I'm hearing in what you're saying is that while we're experiencing higher inflation, that doesn't necessarily mean high or worrisome inflation.
Yeah, you're right, Lauren. That's correct. High inflation, what does that mean? It means, in a way, an inflation out of control of central banks. Our view is that high inflation is not a threat today. Part of that perspective is anchored in the fact that more productivity gains should compensate for higher wages.
Well, one of the things that makes this debate around inflation particularly challenging is something that you brought up, the fact that structural drivers impacting inflation are often multi-decade trends, and their impact is difficult to measure, as I mentioned at the top of the program. And you just talked a bit about productivity. Technological advancement is particularly difficult to measure and estimate. And so with this much uncertainty around these major structural drivers around inflation, is market pricing too complacent around inflation risk? What are the risks that inflation actually moves higher than we expect it to and surprises central banks?
Yes, all this is true. I would add that after more than 10 years of negative inflation surprises, investors may naturally tend to be complacent about inflation. That's true. It's indeed difficult to anticipate a reversal of previous trends, and this is often seen in hindsight. Let's therefore look at the forces at work, and you can see on the chart some of those forces, some of which are conducive to more inflation, some of which are reducing it. You can see upward and downward arrows that symbolize opposing forces and show the difficulty today of reaching a clear-cut conclusion. Some structural drivers of inflation, such as technological innovation, will continue to point to further disinflationary pressures. However, there are important structural factors that point to potentially higher inflation in the future. One example is globalization, which may now be turning into deglobalization. This makes it more difficult for companies to manage their production and supply chain. The resulting increase in labor and logistic costs will likely be passed on to consumer over time. Another example is climate change. Already in Europe, the price of electricity has been multiplied by 2 or 3. It's a huge increase to absorb as a direct result of changes in carbon contracts put in place and the energy choices made by some countries, such as Germany, which is moving away from nuclear power. We can add to this the costs related to extreme weather events, and the cost of renovating buildings are also likely to increase. One thing is certain, however: sustained higher inflation over time means higher wages, and therefore greater bargaining power for workers. This would constitute really a major change compared to the pre-COVID world, and in our view, it's far from certain.
I completely agree. It's very interesting and fascinating to watch. And I'd like to come back actually to this higher inflation scenario a bit later, because I think it's important for us to consider. But for now, I'll just ask what you're thinking in terms of your base case scenario. It sounds like you both believe that inflationary pressures may firm somewhat, but remain near central banks' targets, or at least within central banks' control. So Nadège, what does that mean for you in your asset allocation views?
Our asset allocation today is determined by the expectation that nominal interest rates will continue to rise, driven by both inflation expectations and also a moderate rise in real interest rates. This means, first, reducing portfolio duration, maintaining exposure to inflation-linked bonds, And on the equity side, pay more attention to valuation. It means diversifying regional exposure, looking for more value or GARP styles, and keeping a preference for companies that have really pricing power. And three, it also makes sense to take some exposure to commodities. Some metals could really benefit from a scarcity effect in the coming years.
Okay, excellent. And Michael, now bringing you back into the conversation, it's clear that inflation doesn't impact investments all on its own. There's lots of other factors that investors need to consider, including the nature of inflation. How strong is it and how expected is it? And as you mentioned earlier, the different ways that inflation can impact asset class returns, sometimes positively, sometimes negatively. So how do you organize all these things together to come up with an investment perspective?
Right. So it's definitely true that expectations play a pretty important role in what investors can hope to gain from positioning for inflation. And the same holds true for economic growth. In fact, the interaction between realized inflation and economic growth compared to market expectations for those variables is particularly important. Asset prices respond to expectations that the probability of future cash flows is going to change. In other words, asset prices should react more strongly to unexpected news than expected. In fact, one could argue that assets shouldn't respond at all to expected events because markets are discounting mechanisms. They should have already discounted what's expected. So if reported inflation comes in on expectations, that should already be priced into the asset. So it's unexpected news that should move asset prices.
Okay, that makes sense. And I think most of our audience would agree that expectations are what changes the market in many circumstances. But can you give an example of how this is played out with respect to inflation?
So whenever I talk about inflation, I like to go back to the period from starting in at least the early 70s. So let's take the period from 1972 to present as an example. When inflation and growth both surprised to the upside, some of the asset classes we consider as inflation hedges, such as resource-related equities and commodities, showed strong gains, whereas REITs and bonds show modest declines. But by contrast, if inflation surprises to the upside, but growth doesn't match it, then commodities do even better, but resources-related equities suffer. Gold will show strong gains in that environment as well, and REITs and bonds show modest gains. So as you can see, if you're thinking about an inflationary environment in a vacuum, it isn't enough. You have to consider the characteristics of inflation in conjunction with factors like economic growth and market expectations.
Makes sense. And I hear some of Nadège's asset allocation takeaways shining through there. But what do you think, Michael, that framework tells us about today?
So a framework of growth and inflation could give us some clues to where risks could be looming down the road. Current expectations for both growth and inflation are among the highest of the last decade. So if either growth or inflation expectations are missed, asset performance will likely look quite a bit different from a high growth, high inflation scenario. If both inflation and growth expectations are missed, then market volatility could spike, risky assets could very well suffer.
Well, that's a great segue going back to that scenario of high inflation, which I promised we would come back to. So Nadège, if we were starting to see evidence that we were wrong and inflationary pressures were taking hold in a stronger way, what would that scenario look like in a portfolio? And are you considering that in your asset allocation?
Yeah, maybe first, I completely agree that surprises are more important. So I agree with Michael in the short term for financial markets and the absolute level of growth or inflation for the next quarter. And this will probably increase volatility. I think the month of September gave us an idea of these phases of doubt. Stocks were down, bonds were also down, and volatility was up. The fact remains that investors are not positioned today for persistently high inflation or persistently high growth. Investor sentiment and positioning is now a little bit more defensive, I think. So for us, over the longer term, in that case, I think that quality companies exposed to growth themes are to be favored, with regional diversification towards Europe and certain emerging countries, of course. This is a kind of real asset. Equities are the only asset class to produce positive real yields and are well positioned in a higher inflation regime. Secondly, I would say that real assets such as commodities and real estate should do well if we continue to have positive surprises on inflation. And finally, adding yield with some decorrelations such as absolute return strategies or private equity can compensate for the role that government bonds no longer play in a diversified portfolio.
Well, what I'm hearing from you both is that the impact of inflation is complicated, but that in a way, regardless of the scenario, inflation scenario for investors, there are plentiful opportunities. And so in the meantime, being flexible, being engaged, working with seasoned managers to navigate which scenario we're moving closer to is perhaps the most important takeaway. Thank you both so much for setting the stage for us today. Thank you for your time.
Thank you.
Before we move into our next conversation, I would just like to remind everyone that we have a Q&A box at the bottom of the screen. Please feel free to submit questions for any of our speakers here today. We'll have time for those at the end. And as by means of quick pause, I'd be interested to launch our poll and to see what you think about the inflationary environment. You heard from our speakers that they're not as concerned about inflation running away from central banks, but don't take our word for it. See the poll on your screen and answer the following questions. First, what are your inflation expectations? Do you expect inflation rates to return to pre-pandemic lows, that inflation will firm modestly, or that it will increase substantially? And when do you expect the first Federal Reserve rate increase to take place? As early as next year or a little bit later on? All right, now that we've given folks some time to answer those questions, let's take a look at our results. Very interesting. All right, so about 46% of us, about half, agree with our panelists that inflation will firm only modestly, but 40% about are more concerned. They expect inflation to increase substantially. That's really interesting. And again, speaks to working with managers who can provide some flexibility as we experience this potential regime change. And then when it comes to the first Federal Reserve rate increase, we have some expectations for early next year, a more hawkish crew. And so that's very, very interesting and something for our next panelists to keep in mind as they as we bring them on board. So I'd now like to introduce some asset class ideas, and we're going to get more specific, specifically starting with fixed income. And so Nicolas, I'd like to invite you to join me on screen. Hello, good afternoon.
Hello, good afternoon, Lorraine.
Well, earlier in the discussion, we heard from Nadège how Candriam's asset allocation team is considering inflation. And so as the global head of fixed income, how worried are you about inflation? Are you on team transitory or team durable, as it seems many of our audiences today?
So thank you for this question, and thank you for the invitation. So my answer is transitory. But I would like to come with more explanation, because clearly inflation is the elephant in the room for a bond investor. That's clearly something important for us. So clearly inflation is back. And here you have one graph with the US inflation and the main contributions. You clearly see that inflation surprised the consensus during the summer and over the last months. But food and energy have been the main drivers in many countries. As Nadège has explained, we have also specific factors. In Europe, for example, the evolution of the natural gas, and in emerging markets, the evolution of commodity pricing and also agricultural pricing. So clearly inflation is back. We have today high inflation in the US, and the supply chain disruptions and imbalances between supply and demand are also a key driver of this inflation episode. I would like also to add the experience of the shortage of workers, shortage of commodities. That's exactly what we are observing in the UK, for example. So all these factors seem to be transitory, but obviously it will take time to resolve this disruption and these factors. And nobody knows exactly what does it mean by transitory. When I look at the expectations and the market expectations now, the market expects, not the market, the economists and the consensus survey expect 3.1% for 2022. Is it really transitory? That's a question. I think also that's important to closely monitor the second round effects of inflation. And I would like to take two examples. The first is the evolution of the rents. You know that it represents 32% of the US CPI, which is a clear risk if we see an acceleration of the housing price market. And the second effect is obviously the wages. And here we wanted just to share with you a survey compensation vis-a-vis the job opening. And the graph is very clear. There is a strong acceleration, especially for the low-skilled job. So inflation, that's a fact, and we have to monitor this second round effect. And that's the reason why we say, yes, it's transitory, but that's remain, and it will remain an important topic for 2022.
Well, thank you for sharing those thoughts. I'm interested to hear how that view on inflation, very well considered, impacts your view on monetary policy, which is, of course, so important for fixed income, and specifically how that might impact your view on duration management.
Yeah, that's a very good question. And I was very interesting about the polls and the result and the fact that 40% expect a first Fed hike in the coming months, in the first quarter of 2022. So clearly, the first point is inflation is running above most central bank targets. And the market and also the policymakers expect that the pressure will be temporary. But what is important for me is just to insist that there is a new monetary policy reaction function in the US and also in Europe. We are really in an uncharted territory. In the US, for example, the average inflation targeting, coupled with the goal of bringing full employment across all categories, has been a game changer because there is new monetary policy, a new function reaction by the Fed. What are the main consequences? I would say three consequences about the Fed. The first is the FOMC should be less responsive as it was previously when we have an inflation above 2%. The second point is clearly the priority by the Fed is to bring back as many people as possible in the labor market. And it doesn't seem to be a real success today. And for me, an issue, a question is to know how the Fed can really manage two contradictory objectives. The inflation in one end, and in the other end, this full employment across all categories is not easy to know. And the third consequence is clearly the transparent forward guidance and the transparent communication mean that the Fed would like to avoid to repeat the 2013 taper tantrum episode. And that's the reason why last FOMC announced that tapering could start sooner. And now the dot plot means that we are expecting, according to the dot plot, one hike in 2022. In terms of duration, concretely, what does it mean? We are short duration because we are in this environment where we have higher inflation and when we are expecting the first step of a normalization. But at the same time, we have to be cautious because it's costly to sell US duration and to sell bonds. So we are slightly negative duration and we are follow carefully the Fed and the evolution of the monetary policy in the US.
Well, how do you then layer, first of all, thank you for your comments, but how do you then layer your thoughts on credit into this picture, make it one step more complicated?
Well, for inflation itself is not a threat for credit. Inflation can be positive for companies, depending on the pricing power. It can support also organic growth sales. So it really depends on companies, and it depends on sectors. But for me, clearly, the main, I would say the main conclusion is dispersion and selectivity. Because with higher inflation, we are expecting higher dispersion. And dispersion will increase because company will act differently with increasing pricing. That's what we are observing in some automobile industry in Europe. Or just second solution is just to look for more and to increase productivity or consolidation or just deterioration of the profitabilities. So everything is possible. It's really case by case. And this is an environment. And also because we are expecting the end of the QE, it will become more difficult to make money with credit. So we can continue to invest credit by staying very selective. And dispersion will create a lot of opportunities for bond investors. But selectivity will be key.
Well, case by case and selective, some words that we're seeing throughout our presentation so far that I'm taking away. Just specifically for your team, I know that Kindriam works with a broad range of clients on a varying set of needs. And so case by case is certainly a part of your mantra. But for our investors in that group who are maybe quite sensitive to inflation, what strategies would you say are most important or appropriate?
Well, in this environment, of course, inflation can be the enemy of bond investors. So we have to find other solutions, and we can really come with interesting proposals. So I think we have clearly three strategies offering a good risk diversification against higher inflation. The first strategy is the global inflation short duration. A lot of words. Global inflation short duration. Here you show me and you illustrate with the market expectation. We are looking at here the US break-even rates. You can see that we have higher US break-even rates, but it remains significantly below the CPI forecast for 2022 and also for 2023, because we are expecting inflation above 2% in 2023. So first, we can invest in inflation link, because with inflation link, we have clearly the ability to protect the real value of your portfolio, and we can really preserve the purchasing power. That's also interesting to have a global inflation short duration, because short duration, that's interesting to have a low and flexible duration across the global inflation market. Because with low duration, we can really make and generate a positive return with higher inflation. So that's really the first strategy, is adding inflation link with a global inflation short duration. And that's really an interesting risk diversification. The second interesting strategy is convertible. As a bond investor, of course, we will be happy to benefit from the equity appreciation. So by investing in convertible and a global convertible defensive, we can really combine the options with equities, and we can benefit from positive equity returns thanks to the convexity of the convertible bonds. This is also interesting to invest in convertible because we have a low interest rate sensitivity. Effectively, when you look at the sensitivity of the convertible bond market vis-a-vis the rates, it's very low. So we can have a positive return despite higher inflation. And last but not least, I think that the global defensive convertible, it's a good solution because the defensive product, it's interesting in this environment. We are expecting higher inflation and potentially higher volatility in equity markets. So a defensive approach with a delta between 20 and 40%, it's interesting for a convertible equity investor. The third strategy that I wanted to highlight today with you is absolute return credit. Because, well, credit is interesting, but obviously has become very expensive. But it makes sense to continue to invest credit with a long-short approach. Long-short because we can benefit from good performance. We can really play the dispersion, the case by case. You can select the good names. And with a long-short product that we have within Kindriam, we can have a minus 50 or plus 50% exposure. So that's really important, and that's very useful to generate positive return despite higher inflation or despite higher dispersion. So all in all, I think clearly inflation, convertible, absolute return, three interesting solutions in this environment with higher inflation.
Three really, really interesting ideas, but we did begin our conversation with you saying that you weren't particularly concerned about inflation persisting. And so I'll ask then what you're thinking with respect to your base case. Are these the strategies that you're working with most consistently, or are there other perspectives that you're sharing with clients?
I tend to agree. And I would like just to come back with monetary policy. We are now at the beginning of a new trend. When you look at the monetary and central banks, we are just at the beginning of a tightening cycle. Look at the Bank of New Zealand, Bank of Norway, Bank of Poland. More and more central banks are turning more hawkish since the beginning of September. We are also expecting a Fed tapering. So clearly we are in an environment where we are expecting monetary normalization. In this environment, we need to be cautious about US duration and about long bonds. So we are more cautious with US duration. We still are positive on inflation-linked bonds. We still are positive on commodity currencies, on some emerging market currencies. And about credit, we are not negative, but as I've explained, we are more cautious and we want really to be selective, especially after some turbulences and events in China. So I would say we have to navigate in this environment, long duration, long inflation break even, and more cautious about US duration and about global duration.
That's another vote then for being very careful about duration and rates exposure in this environment. Nicolas, thank you so much for joining us and for sharing your expertise. I will now invite Simon to join me, last but not least, and to discuss real estate. Hi, Simon. Good afternoon.
Good afternoon, Lauren.
Well, I apologize that we're putting you under the gun here to make sure we have time for questions, but we look forward to your thoughts. And I'll ask you the same question first that I've been asking everyone, which is that do you join our first three speakers and some of our audience expecting that we'll see moderate inflation, or do you join the rest of our audience, which expects inflationary pressures to persist?
Well, I think we're in a kind of a scenario where inflation is relatively bounded and quite predictable at the moment. So I think inflation is going to run at slightly higher levels than it has in the past. But I think, to some extent, as this chart here shows, we're not quite 1970s territory just yet. I think that the big risk in my view is really around expectations. Like everybody, I'm quite concerned about some of the recent data, particularly some of the supply chain disruption. We're watching expectations very closely, and I think inflation volatility particularly has a role in de-anchoring those expectations. And if we de-anchor expectations in the medium to long term, it typically takes a pretty deep recession to reset them. So, I think if we get into that kind of territory, as history shows us, that's generally a pretty challenging environment for investment assets. But that's the thing that we need to kind of watch most closely rolling forward.
With respect to what we do with that as investors, what we do with that uncertainty, Nicolas just mentioned some tactical strategies related to shorter duration and absolute return. But in real estate, it can be quite difficult to be so tactical. You're looking over the full credit cycle. And I guess, first of all, do you agree with that statement? And second of all, how attentive are you really to inflation when you're working on investment strategy? How does that impact your view for the next year or two?
I think you're absolutely right. This stylized chart gives you some feel for how we tend to try and think about the different kind of risks and strategies that we see under different inflation conditions. But it is quite difficult to, adapt tactically to different inflation environments. I guess the nice thing about private real estate is that there are a range of different options for you on the menu. And each of them offers a slightly different way to adjust and optimize on a risk-adjusted basis, given different levels of inflation expectation. So, in terms of what you can do on the debt side, obviously the private debt market's very extensive in real estate. You have senior financing, you have stretch senior financing. You can finance on transition assets for repurposing and repositioning. You have mezz credit, all of those behave slightly differently under different inflation conditions. On the equity side, you have different risk profiles as well: core plus, value add, opportunistic investment styles. All of them have different operating leverage. All of them have different levels of financial leverage. And again, all of those tools are useful things to have in your toolbox if inflation conditions start to change. You know, the general perceived wisdom is the riskier the strategy, the greater the necessary benefit under a high inflation outcome. I think the one area where I'd be a bit careful about is sort of what happens if we get into stagflation, though. To the earlier speakers' points about sort of surprises and unexpected outcomes, you know, I like surprises, but nobody really wants a stagflation surprise. So I think that's where we kind of struggle a little bit from a real estate standpoint, is what to do if we do see stagflation appear. It makes life a lot less predictable in our sector. It always comes with a mix of change of participants in our sector as well. On occasions, that leads to a breakdown in our market, in market discipline, and a change in the cycle. So the thing we tend to watch for more in terms of the way we tilt our strategies is to watch for those indicators around, you know, bad market discipline than necessarily worrying too much about your tactical positioning. But there are things that we can do to position for different inflation, different inflation outcomes.
Then I have to ask you what those things are. I'll start with, if we do see a higher inflation scenario, and I love what you said, I love surprises, but nobody loves a stagflation surprise. If we did get closer to inflation surprise, or if you saw that unfolding in the indicators you're watching, what would you say with respect to real estate and positioning?
I mean, on the debt strategy side, I mean, everybody's going to rotate up towards the stretch senior end of the market and into the mezzanine finance end of the market. It tends to work better in an inflationary environment, simply because you get a strong growth cycle, you get a bit of inflation to feed into rents, and because particularly in Europe we have indexation, we have CPI indexation in our rent contracts. The equity buffer starts to shift. So on the credit side, you get a build-up of the equity buffer pretty quickly if you get into a high inflation environment. So riskier loans, actually, you start to get a little bit more buffering in them. Our general rule of thumb is that, you know, the point at which a loan moves from being, you know, subordinated high yield to, you know, high quality investment grade is at about a 60% loan to value ratio. So it's really about sort of that shift from investment grade to high yield, or high yield to investment grade. Ultimately, if you get a lot of inflation, that buffer builds pretty quickly. You bring that LTV down and you suddenly get a big pop there. So, you know, the boost to the collateral when you move sub 60% is really great. And, you know, I think a lot of people like the kind of credit pop that you get when you enhance collateral by building that equity buffer. The other thing is, in Europe, again, we tend to lend off spreads to you know, Euribor or off SONIA. And so inherently, we have a little bit less sensitivity to convexity into the yield curve. So again, that kind of helps people. And as I said, people tend to rotate to the kind of the more subordinated form of the credit markets for that protection. On the equity side, the introduction of leverage is a real driver of outperformance under conditions of stronger inflation. So, you know, people want to add operating leverage, you know, the ability to mark rents up by CPI indexing rents and driving up rents, and to you know, use the parlance earlier on, is sort of boosting that cash flow component. The other thing we take advantage of significantly is putting more financial leverage into transactions. So, you know, a lot of financing over here is fixed cost financing, and again, that tends to work really well. So you get the benefit of the improvement in cash flow goes straight through into the equity there. It doesn't get sort of soaked up in the debt stack. In terms of types of strategy, you know, the core end of the market on the equity side has less leverage. It's generally long lease. So it looks a little bit more fixed income like. It rarely has much more than 20% leverage in the capital structure. So you get kind of an index return. It's harder to filter the inflation effects through into your cash flow there, because you tend to just get plain CPI indexation. You can't grow cash flow rapidly. Core plus strategies work a little bit better. They've got a bit more financial leverage in them, 40 to 50% levered. They usually take a little bit of leasing risk on. So you get the ability to actually grow beyond the CPI indexation in terms of cash flow. they quite often represent a bit of a risk-adjusted sweet spot because you're tending to lean a bit more in the market, a little less on the sponsor. So you do quite well in those strategies. Opportunistic funds have the ability to, really generate quite significant returns there. It's not untypical to see 13, 14% returning strategies turn into mid-20s or 30% returns in this sector if you get a lot of inflation and the manager plays a cycle well. There's no great supplies there. There's 70% levered strategies. So you're really riding a cycle, taking a load of operating risk. You've got a lot of financial leverage in the structure. The challenge in that segment is really manager selection. You pick the right manager, you can make a significant amount of capital profit and do really well. If you pick the wrong manager, it can be really quite challenging. So, it's a part of the market where there's significant dispersion between different manager selection bases.
Really incredible amount of insight in one answer, Simon. Thank you for sharing that range of opportunities. It's very interesting to see. I'll ask then in 1 minute or less, what's your base case? What do you see? What are you focused on right now with respect to this market?
The way that we sort of looked at it is if inflation steers near or below 2%, then we're going to be allocated across all of the various strategies for the clients that I've described. So, we tend to spread things around. Once you start to creep above 2%, then you start to rotate up into the slightly riskier strategies. And then if you're tipping into a place where 4% inflation is viewed as the norm, then you'd shift much more onto the equity side than the debt side. But right now, I think we're taking a pretty balanced approach to it. We think inflation is going to be a little bit above 2% and perhaps push a little higher over the intermediate term. So we're shifting up a little bit more risk in the portfolio, but not substantially more at the moment.
Thank you so much for your insight and for your comments. Very, very much appreciated. And we've now reached the end of our prepared remarks for today. And I'm leaving the conversation with a few key takeaways. First, our group is not concerned about durable inflationary pressures, but they do acknowledge the potential risks due to challenging underlying structural factors and things like deglobalization or climate change, as Nadège mentioned. I also took away that the impacts of inflation to asset class performance can be complex and sometimes depend on the trade-off between higher cash flows in some cases and higher discount rates in others, and sometimes at the same time. And so to address these risks and uncertainties, investors should look for manager flexibility and a global opportunity set. I'm also taking away that some investors will be more inflation sensitive than others and should consider the appropriate strategies. And that's one of the reasons why we gave each of our managers today some time to talk about what would happen if inflation moved higher and what would be appropriate there. And then for our managers here today, allocation changes have been more to cushion the impact of higher rates than necessarily higher inflation. So with that, we do have a couple of minutes left. I'm going to invite all four of my panelists to come back to the screen and we will open the floor to questions. Nicolas, regarding inflation-linked bonds, don't you think that they're already quite expensive? Is it too late to buy them?
Well, I agree that we have seen a dramatic appreciation of the inflation. And when I look at the performance, that was impressive. However, when I look at the inflation expectation, there are still a lot of opportunities, not just in the US, but for example, in the Australia bond market, we like break-even in Australia. In Germany, this is still low when I compare to inflation targets. And in the US, well, yes, that's expensive, but just look at the 5 years break-even or look at the break-even 10 years. It remains significantly lower than the current inflation and than the inflation in 2022. And as you know, inflation is always a question of surprise. And I am not sure that the investors are fully ready for an inflation above 3% in 2022. Not sure. So clearly we can buy inflation. I recognize it's expensive, but as a bond investors, the question is to make a choice. And the choice is to invest in inflation and to sell nominal bonds. So this is really a relative value trade. You buy the linker, you sell the nominal. That's my answer. And the second point is what I've said, is diversification. We can buy other markets like Australia or Europe.
Very, very well said, Nicolas. Thank you for that perspective. And I'm afraid we only have time for one more question, but what I'll say for those who have asked additional questions is that we will follow up with the answers to these and make sure that you get a response. But a couple of folks have asked actually whether the results of our polls, which I think are a bit surprising to us, are what we're hearing in the marketplace. And Simon, I'll put this question to you because you work extensively with both US and European investors. Are clients globally really focused on this? Is it equally a topic of interest everywhere?
It's interesting, actually. I mean, our US clients, it is absolutely top of mind. I've been speaking to them extensively over the last few weeks, and every time we pick the phone up to them, inflation is the first thing that they want to kind of discuss and talk about as part of the kind of strategy on the allocation side. It's less common in Europe. And I think it's becoming increasingly common in the conversation, but it's been less of a pressure in Europe. But I think it's going to become more pressing as we start to see some of the supply chain issues build up in Europe, particularly given what's happened to gas prices and commodity prices over the course of the last few weeks.
It's really, really interesting. And I'm sorry both to our audience and to our panelists that we're out of time for some of these wonderful questions. I want to be respectful of all of your schedules. Again, we'll follow up on the remaining questions with our stellar panelists here. And we just want to thank you all four of you, for sharing your insights and expertise on this topic today. And thank you to our audience for taking the time to listen. We hope you have a very nice afternoon.